for the latest in our series of climate change webinars that are designed to help firms to respond to the PRA requirements. Delighted to see how many have joined us, and I see that there's still more joining now. This session builds on the earlier ones where we focused on the overall roadmap, aspects of governance, and some of the climate risks that are arising. We'll be looking at some of the aspects of risk management, the considerations for developing the risk framework around climate, using scenario analysis, the risk program, assessing materiality, and then reporting and disclosures today. As before, there's no single way to approach things, but we will be setting out some of the things to think about and suggesting options as we go through. Then there'll be the opportunity to raise questions, and we'll try to answer as many as we can. For those who don't know me, I'm Richard Whale, partner in BDO, and I do a mix of financial services, internal audit and regulatory work, and environmental measurement. I'm joined by my colleagues from the BDO ESG group, Dora Grant, Gloria Perez-Torres, and Mark Spencer, who along with others have been developing our support offering and delivering it to firms. To be clear, we're not climate change scientists. We claim no superb insight into the future. However, we do understand business strategy, risk management, reg compliance, scenario analysis, and financial reporting, and we do have experience of measuring and reporting on emissions. And we've focused on the practical ways for firms to address the requirement and to manage their impact. Next slide, please. First, the housekeeping points. Today's webinar is going to be recorded and we'll circulate the slides in a few days' time. Your lines will be automatically muted throughout the webinar, so you can't speak out if you want to. But please do submit your questions as we go through the session using the Q&A function at the bottom of your screen. We may answer them as we go along, or we'll look to cover as many as we can at the end. If any of you are having any problems with sound, please let us know through the chat function and we'll try to do what we can about it. Next slide, please. Before I hand over to Dora, I just want to leave you with a quotation. Now, you might be thinking this is a bit over top with references to evil, but if you replace evil with disaster, then I think this quotation works. Climate change is a big phenomenon. It's going to hurt a lot of countries. It's going to hurt a lot of industries, people, both physically and financially. Stopping it is close to impossible, but the more it can be slowed down, the more those impacts can be managed. For the benefit of your firm's financial health and reputation, it's important that you do manage the risks. Superficial compliance and bland or exaggerated disclosure statements are not going to help. And as the climate goals slip, the blame's going to be allocated. The FS sector can have a massive influence on behaviours, and government is looking for it to take a big drive in making industries shift to climate responsible behaviours, as well as safeguarding the sector. And it's making increasing noise about what it's expected. That is, if those in the sector are willing to act. Over to you, Dora.
Thanks, Richard. Good morning, everybody. Thank you so much for joining us today. My name is Dora Grant, and I'm part of the Prudential team. I've been in BDO for a year now, and prior to that, I've been a CRO a few times and head of governance for a larger insurer. My team here at BDO is formed of subject matter experts providing advice on a variety of risk management topics, including solvency, liquidity, recovery and resolution, wind down, and of course ESG. We do this across all types of financial services firms. My clients are mainly firms looking to obtain a license, fintechs, but also on the most mature and smaller firms with small budgets who still want to do things right, but need a consultant that understands them and doesn't over-engineer. What we've got right here on this first slide is a basic risk management roadmap. And this roadmap shows non-exhaustive lists of points that firms should be considering and addressing this year. But you may, of course, wish to do it in different order, depending on what makes sense for you and how important each of these points are for you. I'll be covering points 1 to 5, which are more geared towards the building blocks of the risk management framework. And my colleague Gloria will focus on providing you a little bit more practical advice given her experience, and Mark will finish with disclosures. Also, a note to say that whilst we will not be covering point number 10 today, it is a crucial point. It is imperative that once you go through the effort of implementing all this wonderful work you're doing on your plan, that you ensure that it's embedded in your day-to-day management, that obviously you start to test the operating effectiveness of what you do, and of course that you reflect the work done in your regulatory documents. Next slide, please. Now, this is a risk management framework, a basic picture. Now, whilst not new, climate risk is a key challenge for financial services firms, regulators, and the society in general, as Richard just mentioned. This is even more challenging given that this is a risk that, unlike others, there's a degree of certainty that as a firm, it will affect you or your stakeholders, but the question is how and when. And to add to that, whilst it may not be something new, it's a topic that financial services professionals are still building up knowledge on in the context of financial services, at least. So we do have clients that find it hard even to know where to begin. And the first reaction is just to say, well, it doesn't affect me, or we don't really know how it's going to affect us. But in reality, the way you should approach this should be no different from any other starting point for any other risk. And the questions you should be asking yourself right now are, how will I effectively identify, assess, monitor, report, escalate, mitigate, accept climate risks, considering, of course, the idiosyncrasies of these risks and how they may affect your firm, your clients, and your stakeholders? And what do I need to do in order to embed these? And the way funds respond to these questions is probably the bulk of what you need to be doing right now. And whilst the approach should be proportionate and evolve and mature over time, as the regulators expect, the important thing is that you need to start acting now. Next slide, please. Now, in the previous webinar, we talked about what some of the physical and transition risks impacts would be. And a good place to start, as always, is to look at your business model, your strategy, and your company values in light of these impacts. So how much is your business likely to be affected? Do we need to do anything to our strategy to ensure that we remain resilient and the ready transition scenario? Should we be adjusting our corporate values? And with risk always comes opportunity. So are there any opportunities I should be looking at right now? For example, venturing in carbon-friendly sectors. And this may be something that you already know the answer for, or something that you will only know once you do your work, or you have the results of your stress testing. But it's nevertheless something you should be considering. Now we move to the taxonomy, and I would like to take a moment to note how important this framework component is and how often it is underestimated. The taxonomy is actually the tool that underpins the overall framework, so please do ensure that you take some time to reflect on whereabouts in your taxonomy climate risk should be added. Should it be climate risk or ESG? Should it be a cross-sectional risk or a standalone risk? Should it be an L2 risk? Also importantly, be sure that you identify some risks of climate change. But Gloria will expand on this a bit later. Once you have the right taxonomy in place, you can then look at your existing framework tools to embed climate risk. And in terms of events and issues management, what we recommend is that if you haven't started yet, that you should be starting by now to record internal and external risk events, near misses, issues, so that you can start to build that historical data. And of course, as a tool that allows you to see how risks have crystallized in the past, it's key that you investigate root causes and document lessons learned. With regards to risk assessment processes and tools, it's important that you ensure that your CSAs incorporate climate risk considerations and should you also be adding climate risks to your top-down register? Should your policies be changed? And also important is that once you look at your existing processes and controls to ensure that once material impacts are assessed, you know what needs to be mitigated at this point and which processes and policies need to be adjusted. For example, if you're a bank, do you need to, and you do lending, do you need to adjust your credit proposal templates, your credit assessment tools, your business impact analysis? Gloria will speak a little bit more detail about governance. And the last tool I would like to talk to you about today is the scenario analysis tool. The main objective of scenario analysis exercise in the context of climate risk is to allow you to understand the potential impacts of future physical and transition risks on revenue, on investment decisions, on solvency, but also importantly, and please don't forget this because it's really important, on clients, on suppliers, and on your material stakeholders. For those scenarios where material impacts are expected, then management action should be implemented to prevent risks from crystallizing. Next slide, please. Before performing the scenario analysis or as part of the exercise, firms need to start by assessing which risks they are exposed to now or will likely to become exposed in future. This should inform the actual scenarios that the firm will select, but also inform and be informed by the overall risk management framework, which is always something important. And always we say when we do feedbacks for ICAPs. In fact, the response to these apparently simple questions should inform all the framework tools that we just discussed in the last slide, but also the frameworks, and of course, crucially, the risk appetite, tolerance, and capacity. And I will explore this further in my next slide. Next slide, please. Now, we are aware that scenario analysis and stress testing can be one of the most daunting or challenging topics our clients face. So we will spend the last few minutes of my presentation to expand a little further on this topic. There are a few points we suggest you to consider. Well, first of all, and in line with the last slide, firms should start by asking themselves what is one of the most important questions in risk management. What is it that can prevent me from meeting my strategic objectives? And in particular, we should be looking at whether there are any physical risks. What are the most material physical risks which can impact me directly, indirectly, my portfolio, my infrastructure, my people? What are the transmission channels and supply chains that could affect me? So as you see, it goes a lot beyond your lending book if you are a bank. There are also then physical risks to think about. There are also transition risks to think about. And for example, I'm thinking about regulatory risks. Will there be a carbon tax? Most certainly, yes. Will there be a change in risk-weighted assets for products that are carbon intensive? There are operational credit risks, market risks, reputational risks. And and then there are litigation risks that we should be, oh, okay. So I lost the slide for a minute, apologies. And then should you be considering litigation risks? This is easier to understand probably for an insurer, but can also affect banks and investment firms. For example, the risk of being sued for not having acted in climate change soon enough. And then even if none of the above are relevant for you, the impact on macroeconomic variables is likely to affect everyone via GDP, energy demand, carbon pricing, agricultural productivity. All of these are obviously likely to affect stress testing exercises firms need to perform. And if you're a bank, affect your Pillar 2B calculations or a relevant investment firm. Firms should also be looking at testing the point beyond which in their model becomes unviable. And whether, for example, changes in customer preferences, increased levels of the sea should be part of their reverse stress testing. And in terms of time horizon of the scenarios, we are looking at short and long-term scenarios. Up to 5 years, as it's typical in the capital assessment process, to test, a resiliency of your business plan. And for example, you can look at the scenarios performed by Norges Bank and IOPA, both in 2019, if you wish a bit more guidance. And then you have the long-term scenarios, for example, 2050, 2080 horizon. And this is where you're going to test those 3 scenarios. We're considering different transition paths to a low carbon economy. And one thing to consider is that different types of climate change can materialize in different ways, depending on the scenario. So, for example, a sudden shock downwards in carbon emissions could lead to disorderly repricing of carbon-intensive assets, which in turn can create negative supply shock and systemic consequences, whereas an early and more stable policy framework will allow for a smoother asset value adjustment. Now, data. What data would you be using? As it's common with scenario analysis, in particular for smaller firms, at least, the big limitation is data insufficiency. And in the case of climate risks, there's also the issue of lack of integration of the risks with macroeconomic transmission channels. But apart from expert judgment that we use for any other scenario exercise, firms can also use historical data losses, hazard maps, results of their own self-assessment, the KYC process, and of course, hopefully later this year, the results of the Bank of England's scenario to systemic firms. There are also non-governmental organizations that publish data for free. So in case you're interested, please have a look, Google that up, because if not, just drop us a note. We're happy to help you. As any other stress testing exercise, the aim of the stress is to understand, where possible, the impact on solvency and other KPIs and see whether there are credible, and most importantly, we always say this, enforceable management actions, which can be implemented now or when the stress occurs. For example, should you be changing your investment policy? Should you be reducing concentration? Should you change, if you let your lender, should you change your lending policy? And finally, point that is really important is stress testing. It's please do make sure that you take some time for the governance elements. It is, as the results are as important as the assumptions and the challenge. So do document all those. Do ensure that the scenario testing is not an isolated exercise and that you reflect the results and you incorporate that in the risk management framework. It's important that this risk is not seen as siloed. And in summary, lots of work, but hopefully not as daunting anymore. And that was all I had for you in SOAR today. Thank you so much for your time. It was a pleasure. I am happy to take questions now.
Thanks, Dora. We've had a number of questions coming through. I think what we'll do is we'll just pick up one of them now, and then we'll move on and into the next part of the presentation, and we'll look to pick up as many of the others as we can as it goes through to the end. So the question that's come in is in relation to the quantification of the impact of each scenarios on the KPIs. And the question is around, given that there's an absence of data about those, how do you go about doing that, and what's the minimum that firms should be doing about it?
That's an interesting question. We get it all the time. Well, there is a consensus that this is a complex process and iterative. So as any other process, there is a journey that needs to be followed. So the first thing is to ensure that your journey is documented. Secondly, firms should demonstrate that they understand the idiosyncrasies of this risk. That being that it will happen, they just don't know when and to which extent. And the third one is probably answering directly the question. It's okay right now if firms are not able to precisely forecast, and it's okay that the scenario analysis is qualitative at this point, the important thing is that you use that exercise to inform the strategy you need to be changing right now or following right now, and that it assists you in your risk appetite formulation. It's quite important that. Thank you.
Okay, thanks, Dora. Shall we move on to you, Gloria, now?
Thank you, Richard. Thank you, Richard and Dora, and thank you all for joining us this morning. My name is Gloria Perez Torres. I specialize in helping firms with complying with regulatory requirements, and I work with a range of banks and financial institutions in the UK and abroad, covering mainly economic crime, ESG, and climate change risks. What I would like to cover today is the components of a risk management program, how to approach the risk assessment, and how a materiality risk assessment can be used as a tool to help to identify the climate change exposures. This will be based on what I have noted as industry practice through my ESG work with clients, who I mainly help with getting a better understanding of how to implement PRA and FCA requirements according to their business model and the specific environment in which they operate. I hope that today I can share some good practice to help you move forward with adapting your risk management framework to include a robust climate risk component. So a climate change risk management program has a number of components. However, I will focus on only 3 today: governance, risk appetite, and risk assessment. And one of the main lessons I have learned is that governance of risk management is the key for the successful implementation. And also that it has to be driven by the board and the executive team. And in the roles and responsibilities have not been clearly defined, there might be a lack of ownership, and the likelihood is that the project may slip. So firms need to decide really who is going to do what. And for example, is there going to be a need for a project management team or for a steering group? And more specifically, who is going to carry out the risk assessment and who is going to provide the oversight? And then there is the issue of how the first line is going to build ownership and expertise. What are the training needs across the firm? And what involvement would be needed from HR and also from the second line in delivering the training? Then drafting the risk appetite provides a great opportunity for the board to add considerations about the firm's values and the brand, and how do you want the firm to be perceived on issues of climate change? What is your firm going to be doing about your own emissions and those of your counterparties? And what is your position in terms of sustainable financing or investment, and more importantly, broader ESG risks? So the risk appetite statement should define the appetite for reputational risks, as Dora mentioned before, and this requires careful consideration. Some of you may have heard about the deep coal mine in Cambria, which was approved to operate until 2049, so just a year before the 2050 deadline. And it's going to be for use in the UK and European steel industry. And this has brought a lot of criticism. So the question is how your firm feel about being involved in funding or working with such a client or business partner, if you would be in that situation, or how would you be comfortable with the reputational impacts if the returns were really good? So I guess, yeah, it's important to be clear on what client investments or activities will be out of the risk appetite. And then also the risk appetite statement needs to be backed by a more granular assessment of the exposures to determine the limits or thresholds for your activities, which then can be monitored. And this is necessary because if there are no restrictions or limits, then there is no positive impact. And also it's good to remember that in terms of climate change, it's not just the government that needs to take action, but also the wider community, and it what concerns us today, the financial sector. Then in terms of what compares the risk assessment of the risk appetite, it seems like a chicken and egg situation, but in reality, this needs to be an interactive process, also together with the scenario analysis, because it would help to inform the risk appetite. And what we are seeing in practice is that a lot of firms are carrying out these assessments concurrently. And I think this really works. Then moving on to risk management, the climate change risk assessment, or CCRA, has three main objectives. The first one is categorizing and identifying climate-related risk. The second one is managing climate-related risk through control implementation. And the third one is identifying unidentified risk and opportunities. The CCRA involves an extensive and systematic review of a number of climate-related risks, with our financial and also non-financial. And what is more important is that it should tell you what you need to prioritize, what actions you need to prioritize, and whether there needs to be a shift in the approach to manage your risks. And this will require a really good understanding of how policies and socio-economic risk affect you. The exercise will help you to build capacity for the next CCRAs, and it should be a useful tool for different departments within the firm. And the end result should be a characterization of what needs to be done to mitigate the risks. Then it's good to consider how the CCRA and the risk appetite will align to disclosure requirements. And this is to facilitate reporting. And I am not going to cover disclosures because Mark is going to cover that. But I think that what we should consider is at least the disclosure recommendations from the task force on climate-related financial disclosures, the TCFD, and any other relevant reporting obligations. Like, for example, for risk assessment, there are disclosures for strategy and metrics, where firms need to explain what was the methodology for the CCRA, what were the short, medium, and long-term risks identified, what are the processes for managing climate-related risk that the firm has put in place, what policies, procedures, controls do you have, and whether these have been embedded and how within the overall risk management framework. Then it's also worth mentioning that from an ESG perspective, right now all the regulatory focus is on climate change, but we think that sooner rather than later, ESG will be the focus as well. And we know that some firms are already reporting ESG metrics in line with the UN Sustainable Development Goals, or to comply with requirements of the UK Stewardship Code, and some with additional metrics on gender equality. And something to think about as well is, more specifically from an environmental perspective, green crimes, which have a huge climate change impact, should be considered, and these are linked to crimes such as money laundering and corruption. And the question is like, how would you approach this risk? How are they going to be assessed from both third party and customer risk perspective? Next slide, please. So climate change, like Dora mentioned, can be considered as a standalone risk or a cross-cutting risk. But particularly, it should be considered from a credit risk perspective, because financial loss may arise due to climate change. For example, if some clients may be subject to severe climate risks to their operations or their property, and also to transitional risks. And this will increase the probability of default with potential losses to the firm. So from this perspective, there is a question about if there are concentrations, for example, geographical or with sector or industry, and then there is higher risk, and then this climate change risk will only increase over time. So these portfolios and these concentrations would be looked at and should be expected to be mapped to your existing processes. And then from an operational perspective, the main focus is on operational resilience, but other factors to consider are people and culture, like waste, travel, and technology and third parties, like, for example, with cloud or data center providers, there's climate events that may affect them. Or also from the counterparty perspective, they might have poor GSG disclosures or strategy. Another point I want to just mention on this is greenwashing and not meeting customers' expectations. And greenwashing, which is when a company markets itself as green or environmentally conscious, but in fact, they are doing very little to reduce their carbon footprint. And then there is a significant reputational and legal risk in this, because there is a fine line between appearing as environmentally friendly and deceiving the public. And companies are prosecuted and fined for this. Like, for example, Walmart in the United States paid $1 million to settle greenwashing claims that they were selling green plastic when in fact they were not. This can also be linked to fraud. There was a case where a company in the United States committed tax credit fraud, claiming that they produce a clean fuel to claim tax credits, but in fact they were not, and they managed to launder 100 million in proceeds in Turkey to buy property. Next slide, please. Then some firms are choosing to start with undertaking a materiality risk assessment of climate risks to help them to decide what is the best approach, and also as a first step to identify the concentration of exposures. And this is something that is being also suggested by the CFRF guidance. And this makes sense to me, like Dora mentioned, some friends that find it really difficult to even identify begin. And jumping into the full CCRA can be overwhelming. So firms may find it easier to start from simple. And this slide provides an example of what materiality risk assessment can look like. And this model considers a country and sector, the type of risk, whether if it's physical or transitional, then a sub-factor of category like customer asset location or sectoral risk, like oil and gas or mining, and a key risk factor, for example, a high risk region. And then we assign risk ratings to these categories. Then after, this model is based in looking at the firm's specific data based on the number of clients or counterparties or categories. And you will see the 4 boxes in between are just a formula to ensure that we cover the full population and the overall percentage and that the numbers match. And then later we multiply the risk rating by the total number of clients, and this is to give them an inherent risk rating. Then we will calculate the average for the category, and we use a RAC system. So we think this is a useful model. The materiality risk assessment is a good starting point to recognize where your business can get more affected, and it can be a foundation to start the CCRA. Because from there you can continue to build on your CCRA by identifying the controls that you have in place, if you have them. If not, you may have to implement new controls. For the controls that you have in place, you can rate their effectiveness, and then you can consider the impact, the likelihood to determine the overall residual risk. And last but not least, just is the consideration of how the CCRA will fit into the wider ESG risk management framework, if you have it. And if not, then it's time to consider implementing one. Thank you all.
Thanks,
Happy to
Gloria.
take any. Thank you.
Thanks, Gloria. Apologize, I cut you off at the end there. We'll do what we did last time and pick up one of the questions that's come in. And this one's about practicalities and in terms of what's your advice on which is the easiest approach in terms of whether you go standalone or cross-cutting risks.
Okay, yes, this is something that we have considered, we have thought about this. This question has come up before. In terms of the best approach, what we understand that we see is that there are 3 main options. So one is, as I mentioned, the standalone. The second one is the cross-cutting risk, or both. And so if you go for a standalone risk type, then you need to build the necessary framework, build new policies, because everything is going to be new. As a cross-cutting risk, which is the risk within existing risk frameworks, like I mentioned before, credit or operational, you will need to progressively update this risk framework and then update the underlying policies and the procedures, prioritizing where necessary. Depending on the firm, I guess, and how complex the business model is, maybe for the second option, for both options, you will need to implement a plan to make all the changes that will be needed. A lot of firms are implementing a cross-cutting risk framework. However, I think that is best if, and perhaps you will need both, because there will be some risks that will not fit into the standalone or the cross-cutting, like, for example, the reputational risk, litigation, regulatory, market risks. So yeah, I think you need both. Thanks.
Okay, thank you. And now we'll hand over to the third of our presenters, Mark Spencer.
Thank you, Gloria, and thank you, Richard. Good morning, everybody from me. I am Mark Spencer, and I lead our Financial Services Accounting Advisory practice at BDO. Financial Services Accounting Advisory at BDO spans all aspects of accounting, financial reporting and corporate reporting across 5 pillars: accounting change, structuring advice, financial instruments accounting and reporting, climate and corporate reporting, and all other areas of accounting and corporate reporting. One thing that the Financial Services Accounting Advisory team at BDO has been doing over the years is engaging with regulators in the UK and the EU, trade bodies, our peers both locally and internationally, and other parts of the wider community on climate reporting and disclosure. The Financial Stability Board established a task force on climate risk related financial disclosures, or TCFD, to develop recommendations for more effective climate related disclosures. This was done in order to promote more informed investment, credit, and insurance underwriting decisions, and in turn enable stakeholders to understand better the concentrations of carbon-related assets in the financial sector and the financial system's exposure to climate-related risks. The disclosures are aimed at financial institutions and has a goal to provide consistent and transparent information to global markets. To date, the TCFD has only been on a voluntary basis through companies' public annual financial filings, but with the urgency of climate change, action is being taken to make this a requirement. Some of the benefits of better disclosures are enabling more informed evaluation of climate-related risks across firms, decision-making on where and when to allocate capital, and evaluation of risks and exposures over the short, medium, and long term. Firms are recommended to disclose their activities across 4 thematic areas, which are governance, strategy, risk management, and metrics and targets. These thematic areas are interlinked and designed to inform one another. Our previous webinars and the first part of this webinar has covered the first 3 thematic areas of the TCFD framework. I will now cover the primary reporting area of climate-related disclosures, which is metrics and targets, the purpose of which is to assess and manage climate-related risks and opportunities. I say primary reporting area as disclosure is required of the firm's governance, strategy, and risk management in relation to climate-related risks and opportunities. A firm is required to disclose the metrics that it uses to assess climate-related risks and opportunities in line with its strategy and risk management process. This includes disclosing greenhouse gas emissions and the related risks. A firm is also required to describe the targets that it uses to manage climate-related risks and opportunities, as well as performance against those targets. Next slide, please. A lot of the guidance provided by the TCFD on how to implement the recommendations is equally applicable for all sectors. However, supplemental guidance is also provided for different players in the financial services sector in relation to specific thematic areas. It is worth noting that all guidance provided by the TCFD in relation to the governance thematic area applies across all types of firms. We will now speak about the strategy, risk management, and metrics and targets industry-specific thematic areas across banks, insurers, asset owners, and asset managers. And when I'm doing so, please bear in mind that this includes both first-order effects in terms of actual impact on the climate, and second-order effects in terms of lending, insuring, investing, and managing and advising others on where they are to invest funds. In terms of strategy, banks should describe significant concentrations of credit risk to carbon-related assets. Banks should also consider disclosing their climate-related risks, which are both transitional and physical, in their lending and other financial intermediary business activities. In terms of risk management, banks should consider characterizing their climate-related risks in the context of traditional banking industry risk categories, for example, credit risk or market risk. In terms of metrics and targets, banks should provide the metrics used to assess the effect of climate-related risks on their lending and other financial intermediary business activities in the short, medium, and long term. Metrics provided may relate to credit exposures, equity and debt holdings, or trading positions, with these being further analysed by industry, geography, credit quality, and average tenor. Banks should also provide the amount and percentage of carbon-related assets relative to total assets, as well as the amount of lending and other financing that are connected with climate-related opportunities. Insurers should describe the potential effects of climate-related risks and opportunities, as well as provide supporting quantitative information on their core business divisions, sectors, and/or geographies in which they operate. Insurers that perform climate-related scenario analysis on their underwriting activities should provide the following information. Firstly, a description of the climate-related scenarios used, including the critical input parameters, assumptions, and analytical choices. In addition to a 2 degrees Celsius scenario, insurers with substantial exposure to weather-related perils should consider using a greater than 2 degrees Celsius scenario to account for physical effects of climate change. And secondly, the time frame used for the related scenarios, including short, medium, and long-term milestones. When it comes to risk management, insurers should describe their processes for identifying and assessing climate-related risks on insurance portfolios by geography, business division, and/or product segments. This should include consideration of the following risks. Firstly, physical risks from changing frequencies and intensity of weather-related perils. Secondly, transition risks resulting from a reduction in insurable interest due to a decline in value, changing energy costs, and/or implementation of carbon regulation. And finally, liability risks that could intensify due to a possible increase in litigation. On metrics and targets, insurers should describe key tools or instruments, such as risk models that they use to manage climate-related risks in relation to product development and pricing. Insurers should also describe the range of climate-related events that they have considered and how the risks generated by the rising propensity and severity of such events are managed, as well as provide aggregated risk exposures to weather-related catastrophes of their property business. That is to say, annual aggregated expected losses from weather-related catastrophes by relative jurisdiction. Asset managers are distinct from asset owners. On strategy, asset managers should describe how climate-related risks and opportunities have been factored in to relevant products or investment strategies. Sticking with strategy, asset managers should describe how each product or investment strategy might be affected by the transition to a lower carbon economy. When it comes to risk management, asset managers should describe, where appropriate, engagement activity with investing companies to encourage better practices in relation to climate-related risks and disclosure thereof. Asset managers should also describe how they identify and assess material climate-related risks for each product or investment strategy. Finally, on risk management, asset managers should describe how they manage material climate-related risks for each product or investment strategy. Asset managers should describe metrics used to assess climate-related risks and opportunities in each product or investment strategy, as well as provide the weighted average carbon intensity where data is available or can be reasonably estimated for each product or investment strategy. We will finally look at asset owners. On strategy, asset owners that perform scenario analysis should consider providing a discussion of how climate-related scenarios are used, such as to inform investment in specific assets. Asset owners should also describe how climate-related risks and opportunities are factored into relevant investment strategies. This could be described from the perspective of the total fund, or investment strategy, or individual investment strategies for various asset classes. In terms of risk management, asset owners should describe how they consider the positioning of their total portfolio with respect to the transition to low carbon energy supply, production and use. Asset owners should describe the metrics and targets that they use to assess climate-related risks and opportunities in each fund or investment strategy, which includes providing the metrics considered in investment decisions and monitoring, as well as provide the weighted average carbon intensity where the data is available or can be reasonably estimated for each fund or investment strategy. Next slide, please. We will now spend some time on the implementation timelines that are associated with TCFD. The voluntary adoption of the TCFD recommendations to date has been limited. It has therefore been determined that a different approach needs to be taken given the urgency of climate change. As a result, the Chancellor announced within his statement of November of last year that the UK will become the first country in the world to make disclosures that are aligned with TCFD mandatory with effect from 2025. A roadmap has been created that sets out the timeframes for implementation for the different firms within the financial services sector. And what is on your screen at the moment is from a roadmap towards mandatory climate-related disclosures that was published by HM Treasury in November. Initial steps have been taken by regulators, and the roadmap will continue to build on these steps, with the Financial Conduct Authority and Prudential Regulation Authority also proposing further measures for some organisations. The TCFD road towards mandatory disclosure is stepped and is based on organisation type and size. In summary, take-up is as follows: 100% of listed commercial companies by 2022, 50% of UK registered large private companies by 2022, 89% of PRA regulated insurers by 2022, with the remaining 11% subject to PRA supervisory expectations, 75% of asset managers by 2022, which is to increase to 96% by 2023, 89% of FCA regulated life insurers and pension scheme management providers by 2022, which is to increase to 98% by 2023, and finally 72% of occupational schemes, pension schemes by 2022, which is to increase to 85% by 2025. And as I said, all of this is included in a roadmap towards mandatory climate-related disclosures that HM Treasury published in November, and it is available on the internet. Next slide, please. 4 main areas of challenges associated with TCFD compliance come to mind. These are alignment of reporting standards, data availability, scenario analysis, and metrics and targets. A few words on alignment of reporting standards. There are other sustainability reporting frameworks through which firms are making disclosures in addition to TCFD reporting. It has been acknowledged that there needs to be alignment in this area in order to increase comparability across organizations. Actions are being taken by other bodies to address this issue. For example, the International Accounting Standards Board has recently published a consultation paper on developing a global set of sustainability standards based on existing frameworks such as the TCFD recommendations. There is also the Better Alignment Project. As part of this project, the CDP, which was the Carbon Disclosures Project until 2012, the Climate Disclosure Standard Board, the Global Reporting Initiative, the International Integrated Reporting Council, and the Sustainability Accounting Standards Board have collaborated intensively to assess alignment on the TCFD's disclosure principles, recommended disclosures, and illustrative example metrics. The availability of data is a systemic issue which needs to be addressed. This is because there has been a lack of data provided at the corporate level, specifically by private companies. This prevents there from being decision-useful data being made available to asset owners, who use such data to make their own decisions. Some organizations lack the experience of undertaking scenario analysis, and they are therefore finding it difficult to identify both an initial starting point as well as a process to follow. For those organizations who are more advanced in undertaking scenario analysis, challenges still remain. These include a number of technical challenges, which include financial quantification and understanding how to develop plausible scenarios. This is further intensified by the disconnect between the typical time horizon of risk analysis and the longer-term climate forecast horizon. Finally, on scenario analysis, climate modeling also lacks the necessary historical and empirical data that could be used, since the most critical and material effects of climate change have yet to materialize. There has been a fundamental challenge in terms of metrics and targets, as there is, as of yet, no recognized standard for reporting, and as a result, a lot of different methodologies are being used. For example, one of the key metrics that funds will need to disclose is in relation to portfolio alignment. Under this, investors should disclose how closely their portfolios were aligned with the transition to net zero, However, a key issue with this is that the existing climate-related metrics are not well suited to measuring a whole economy's transition. The TCFD has published a report entitled Measuring Portfolio Alignment. This discusses the requirements for common comparable metrics that enable investors and lenders to identify risks and opportunities in the transition to a net zero economy. The key metric that the TCFD report focuses on is a degree warming metric, which shows a potential global temperature rise associated with greenhouse gas emissions from a given company or portfolio. And I will just take a pause here to see if we have any questions on reporting and disclosure. Richard.
Thanks, Mark. Yeah, we've got a number of things coming through. I think probably one of the key ones around this is once you've set the initial metrics and targets, to what extent are you tied to them? Can you change them? Because as more information becomes available, it seems naturally that the metrics should change.
Yes, thank you, Richard. And thank you, whoever asked this question from the audience. I mean, I do agree that with significant increase in disclosures, then there will be a lot more climate-related information that is publicly available. Regulators are also cognizant of this. However, this is why they are encouraging firms to dedicate the appropriate time and resource into devising appropriate climate change risk management and reporting frameworks. The guidance points towards longer-term metrics and disclosures that firms are used to making. Having said this, there are certain disclosure requirements that should not change, such as greenhouse gas emissions, energy sourcing and efficiency, and investment in green finance. These high-level disclosures should be accompanied by the firm's objectives and may also be supplemented by a suite of underlying metrics so as to achieve these objectives. It is these shorter-term, lower-level supplementary metrics and targets that may change and evolve over time, but the longer-term objectives should be more stable.
Thanks, Mark. So in terms of close this out, we'll move on to the next slide, Lauren. So there's a number of things where we're working with organisations around this, which are set out on the screen. Now I'm sort of conscious we're a few minutes behind. So what I'm proposing is we'll run over the hour, and I hope that people can stay a little bit longer in terms of to give us some opportunity to answer some of the questions that have come through, because there have been quite a number. But what we will do is, for ones that we can't answer in this session, we will do answers which we'll send out to people, to everyone at the end of the session. So if we can move on to the next slide. In terms of what a number of the questions have talked about, it's I suppose it's around the parameters of where things go to. And in some cases, we've had questions relating to the fact that they're only dealing with short-term investments or issues within their firm. So how does risk management affect those? In some cases, it's about the fact that you're managing assets for others, and how's that going to work in terms of the risk assessments. And I think in terms of that, that's where this initial impact assessment at the start comes in, for understanding what those implications might be for you. If you're in that sort of position, well, the direct exposure, certainly in the credit side, might be minimal, because you can change things. So you can have quite a lot of confidence around that. However, what you need to keep an eye on is, what does that mean for the markets that you're dealing with? And it's much more likely to be through that sort of side that the exposures might be. And if you're in markets that are likely to be impacted a lot by credit or the transition around it, and be that you're a wealth manager, and it happens to be that your clients are involved in those industries personally rather than as corporates, or whether it's about investment or credit, even shorter term credit around there, it's understanding how those markets might change. Related to that, we've also had a question around the international boundary sort of side of recognizing that a lot of the firms here are working internationally. This is very much a UK initiative. And so the question was around the fact of, given the fact that there isn't that cross-border consistency, then how can firms move this forward? Because you've got there isn't going to be a consistent approach. I think there's lots more countries are moving in a similar way, but I think it's going to stay there very much that some countries are pushing quite hard on what the requirement, and some are going at a much slower pace. And indeed, some countries may actually be not doing very much at all. I think one of the main things around this is looking in terms of, well, how might that impact you? You might not be able to influence any of those behaviours, but it's understanding what that span of behaviours might be, and therefore what the span of impacts might be on you, so that you can look to consider those scenarios and make sure that you're managing them as well as you can. But it is going to be increasingly difficult, and in some places you might actually find contradictory impacts coming through on that. So next question I wanted to pick up was, there's a couple of them relating to insurance companies in particular, and this is looking at it in terms of, well, what are the considerations for them, and in terms of the risk assessments. And so I'm just trying to move to the right question. And the fact that most of the business is written in 1 year's contract, therefore, how can you feed in the long-term climate risks? So, Gloria, can I ask you to pick this one up?
Yes, of course. So I think for general insurers, they will need the risk assessment to cover the risk affecting the firm's balance sheet, and more importantly, the risk affecting the products to the policy holders. So this is how climate events will affect property and the impacts on claims. And so there needs to be a consideration of mitigation controls for both the physical risks, which include acute and chronic risks. So acute physical risks relate to natural catastrophes like storms or wildfires, and the chronic risks relate to things like global warming and changing in weather patterns. And in terms of how to consider long-term risks, some firms are choosing to just indicate that they are aligning to the Paris agreements. So this shows a zero risk appetite and zero emissions by 2050. Thanks. Hope that clarifies.
Thanks, Gloria. Next question is where we've had a request for an example of a sort of scenario that might be used. So Dora, can I ask you to pick that one up?
Yes, so you can do several things, but at this point, I would say it depends on what you do. If, for example, you are a lender, a change in PDs or LGDs would be the best one that you would be doing right now, because that would be what would affect directly your credit risk. And it's probably what, if you are a bank and lending, what would be affecting you more severely. But also about supply chains, what happens if, for example, your outsourcing providers just disappear in relation to, as a result of climate change, and what happens to, for example, your people if they can't come in the office anymore. If you can say that you have already been testing this with the pandemics, but also make sure that you don't only focus on looking at financial risks, because quite possibly what you are at this point underestimating is how the non-financial risks can affect you. And we are all living proof right now. Pandemics is living proof that how something that is not really financial can affect and affect our lives so severely. And that's that. Thank you.
Thank you. Next one is relates to a comment around having a scorecard in terms of, and whether that would be something that would be beneficial in terms of to have a change process. An example that's given is what's been done in South Africa around Black economic empowerment. Yes, I think in terms of it, if the firm wants to have an impact, then you do have to look quite closely as to how you're going to score things. One of the things that we've certainly found, which we've recently built climate into, is when we're doing sort of product risk assessments, product evaluations, in effect, there's a number of factors that are coming into play. And it used to be much more about, well, what's the credit exposure and what's the returns on them, and what's it going to do in terms of our reputation type issues around that. But what we're finding now is all the ESG factors, in particular climate, need to get built into those assessments, so you can see what sort of impact the products might have and whether they're going to be a beneficial or a non-beneficial impact. And that can go much wider than products in terms of that. So I think that would be a good way forward to do that, and ought to feed into the sort of wider risk assessments that are taking place. Just pick up one more of these, which is come through. Where investment managers are acting on behalf of clients in line with investment management arrangements, should they have an investment related risk appetite statement when they are not directly exposed to the financial risk? Gloria, do you want to pick that up? Okay. Oh.
Apologies. Can you repeat the question, please?
Where investment managers are acting on behalf of clients in line with investment management agreements, should they have an investment related risk appetite statement when they are not directly exposed to the financial risk?
I think that, like Fiona, sorry, keep mentioning, Dora mentioned before, I think the statement should cover both the direct and the indirect risks. Yeah, definitely. Yeah, because there will be impacts on both, and then you need to be sure that you manage them equally.
Okay, thank you very much. I'm conscious we've run almost 10 minutes over, so thank you for your questions. I'm conscious we haven't had a chance to answer all of them, and there's quite a number that are still outstanding. So what we will do is we will issue some responses to all the attendees covering the themes rather than necessarily the individual questions that came through. I hope you found it excellent. We've certainly found it interesting, and some of the questions have been certainly challenging. Finally, I just want to thank Dora, Gloria and Mark for presenting to you today, and for all of you for joining us this morning, and wish you all a safe and a good rest of the day. Thank you very much.